Let's get started. So welcome to everybody who's joined us today. You're very welcome. My name's Jo Edwards. I'm your chair of the webinar today. A couple of housekeeping issues before I introduce you to our speakers today. The webinar is scheduled to run for around 45 minutes with some time at the end for questions. So if you think of anything you'd like to ask any of our experts here today, please use the Q&A tool on your Zoom toolbar to put those questions forward. I'll come back at the end to field those. Don't use the chat option if you don't mind. We are going to be putting some useful links and some collateral that you might want to take away with you from this webinar into the chat as we go along. So we're going to use that space for that specifically. Okay, we are also recording this webinar, so if you need to recap on anything that's been discussed, we'll make an on-demand version available to you. Okay, let's just have a quick look at the agenda and let me introduce you to everybody. So we're joined by Mike, Jen, Richard and Kevin. Very welcome. So WhisperClaims and the R&D community. I'm going to let each of them introduce themselves to you when they start their sessions, and we'll have a quick introduction to WhisperClaims and an introduction to the R&D community. We will use those sessions just to explain a bit more about who we are and what we do. So please don't be frightened off from the rest of the webinar thinking this is a sales pitch. It is not a sales pitch at all. There's some really great content in here, but it helps to set the landscape out by understanding what each business actually does. Okay, so quick reminder, Q&A if you have any questions. We'll get to those at the end. And at this point, I'm going to hand over to Mike Dean at WhisperClaims.
Thank you very much, Jo. Thank you. So as Jo said, I'm Mike. I'm the MD and co-founder here at WhisperClaims. Just going to give, I'm conscious of a few people on this call who won't know us, by the way. We've also got a number of customers on here too. So I'm going to just give you a quick overview of our business, and I'm going to give you a little look into our app as well before I hand over to Richard. So I always like to kick this slide off by telling you what we're not. So we're not consultants. We don't do R&D claims for businesses. We work exclusively with accountants and consultants to empower you to deliver R&D tax services under your own brand. We do that with three things. One of us is our award-winning software, and you're going to get a look at that in a minute. A series of learning tools that includes ebooks, webinars and training courses. In terms of the ebooks, I'm going to share one or two of those during the course of the session today, so we get a flavour of that content as well. And then crucially, we have a sort of open advice line support that sits alongside our app. So if you're sat in front of a client, you're struggling with an issue around a particular area of eligibility on a project or the nuances of the scheme, we're there to help you in real time. So what have we got to date? We launched in late 2018. Currently working with around 150 firms nationally, and to date we've processed just over 3,500 claims through the app with a total eligible spend of just over 600 million. So that represents about 150 million of tax benefit delivered to the clients of our customers. I mentioned awards just quickly on the right hand side here. You get a flavour for some of the awards we've won. Key thing here is just that we've been recognised for, from a technology perspective, having taken a sort of people-heavy consultative process and turning that into a software-led process. That's a difficult thing to do. So we've had technology recognition for that, and also recognition from the accounting sector for the contribution we've made to accounting firms in this area as well. So a nice combination. So I said I'm going to show you the app itself. So just bear with me a second while I do that. Just change my screen. There's always going to be a sticky bit. There we go. Hopefully we can see that. So this is just a representation of what would be your dashboard. In the dashboard, you get the ability to manage clients, manage claims. We've even got a tool in here that enables you to manage towards tax payment deadlines and hard deadlines too. If I just quickly delve into a claim itself, give you a flavour of how the system works when you're preparing a claim. It's basically a very structured question set that enables you to build a claim quickly and easily, taking into account of all of the aspects that HMRC would expect you to. You've got dynamic feedback in here, so answers that you give to any particular question that don't meet the criteria will immediately be thrown out. Just over on the left-hand side, I'll just quickly scroll through and give you an idea of the sorts of areas that you're asked about as you work through the system. That kind of culminates in adding costs in all the appropriate areas, as you can see there. Easy interfaces throughout, including easy upload of third-party data if you need it. And we culminate in technical detail, little tool here that makes sure that you're covering the technical detail for an appropriate number of projects and to an appropriate depth. Finishing up with this section here where you're adding that technical detail. And ultimately you get to a review stage where you get an immediate claim risk assessment, giving you an idea of the risks associated with that particular claim, giving you an overview of all of the data that you've put into the claim, and then we finalize and prepare the final outputs. So just to give you another screen share and complicate my life a little bit more, let me just show you the final outputs. We have we'll get there. There we go. So this is the final technical report. I'll just quickly scroll through that. This is the report that you'd append to your CT600, and then we also provide you with a pure text file output for your AIF, which is here. So this has got all of the data that you require for completing the online AIF form with HMRC. It's in a raw text file simply because that's the sort of lowest common denominator from a formatting perspective. So it's easy to cut and paste into HMRC's form. So it gives you a really quick sort of whistle-stop tour of the app and how it works. I'm going to post up a poll right at the end of the session today. So if you want a much more detailed demo, you'll have access to that. You'll be able to raise your hand and let us know that before we go. So hand over to you, Rich, to do the same from your perspective.
Cool. Thanks very much, Mike. So yeah, I just want to take a couple of minutes to introduce the R&D community, give you a quick overview, and also a kind of sneak peek at some of the content that's in the training platform itself before I hand across to Jen to start getting into the meat of the updates. The R&D community is a mission-led company, so we passionately believe that standards in R&D type leave should be higher, and we're doing everything that we can to provide really great training, support, and a sense of community to advisors to help people, get the tools and resources that they need to deliver a great service to their clients, because we believe that the more people understand how the scheme works, and the more that we share knowledge amongst each other, the better service ultimately claimants are going to get, and standards will improve. So there are three kind of fundamental pillars to what we do. There is community support and training. In terms of the community aspects, first of all, this is really, really active. We've got something like 20 different forum groups within our kind of overarching community. Those are on things like AML, technical questions, accountancy questions. There's a whole kind of bunch of information that gets shared on a daily basis. People kind of trading inside tips about how HMRC is reacting to things. So there's a huge kind of value that comes from just people sharing that information and helping each other. It does mean that if you want a quick answer to a question, you can pop it into one of those groups. The chances are somebody will come back quite quickly and answer it. If you don't get an answer, well, we've got our own kind of internal support functions as well, and those are headed up by Kevin. So we've got a free helpline service for our members, and if you can't get an answer, that typically allows you to get an answer quite quickly, so same day or next business day. If the request or a piece of work is a bit chunkier, then we've got other services that we can help you with on an early basis as well. It's essentially consultancy on demand. But really the focus of what I want to talk about is the training side, because HMRC has really ramped up its kind of compliance standards over the last 12 to 18 months. This is impacting people right across the industry, and it's putting training front and center. So all of a sudden this has become really, really valuable and important. So what I want to do is give you a quick look at what's in our training platform. So the way it works is all of our content is video based, which makes it very kind of digestible and convenient. You can pick this up and put it down at your convenience. We've got these kind of full training courses in the top part here. We've got lots of recorded webinars which focus on quite topical issues like volunteer disclosures or inquiries. We've got a collection of resources that are useful for delivering your service to your clients, like a claim calculator. We've got various templates that you can download. We've got recordings of the RDCFs as well. So that's useful to see kind of how HMRC is responding and what they're talking about. And we are very active in terms of consultation responses as well. So there's a huge amount of information in here. But again, pulling this back to the training side of things, the ones that I would highlight are things like this establishing eligibility course, which takes you through all the kind of the core terminology that HMRC uses. And then the other one that I should highlight is the brand new Essential Guide to the Merge Scheme. So as Kevin and Jen will be talking about very shortly, everything has changed within R&D Tax Relief for periods starting on the 1st of April 2024. So because of that, we've built a new course to take you through all of these changes. And the cool thing about this course is it's actually available online for free through our website. So we can maybe stick a link to that in the chat later on. But if you are interested in training or just kind of sampling that, then you can access all of that content for this particular course free. So yeah, that's a great kind of intro into it. Okay, Jen, I will pass across to you to get into your slides. Jen,
Jen, you're on mute, Jen.
Sorry, there was loud typing going on in the background. So yeah, the point of today is to talk about the changes that have happened, the changes that are coming up, and give a little bit more detail about where HMRC is in terms of all of this. So I've been tasked, you'll get to Kevin, who is far more of an expert on this than me in a few slides. But I've been tasked with kind of just giving a quick summary of what's happened so far and what the big changes that are coming up are. So as hopefully everyone on this call knows, everyone knows about R&D tax relief to some degree. Big changes that have happened in the last sort of 18 months, really. So obviously the big change that happened last year is that the rates changed for claim for expenditure incurred after the 1st of April last year, so April 2023. So this was a decrease, so that reduced the SME rate from 130% to 86%, the enhancement rate on that, and it increased the credit rates for RDEC from 13% to 20%. And it also reduced the SME tax credit rates from 14.5% to 10%. So this made a huge difference to the benefit available to SMEs, brought it more in line, the RDEC and SME more in line, which, as they announced then, and obviously has come to fruition, or is coming to fruition next month, this was a way to bring the two schemes into more alignment, so that then paving the way for the merge scheme, which is now coming. Obviously, when this was announced back in the autumn statement in 2022, there was a big outcry about, okay, but what about, companies that are doing a lot of R&D, companies that really rely on this? So the reaction to that was, at the very last minute, the government announced the R&D intensive SME scheme rate, which allowed companies that are doing a lot of R&D to maintain that 14.5% rate rather than the 10%. I'll talk a lot more about that in the next slide, but that's when that came in. For claim periods starting on or after 1st April, so not expenditure incurred after, but starting on or after, that's when the R&D intensive SME came in. They were also allowed pure mathematics for the first time. So as an area of science, claims can now be made in the area of pure mathematics. For the 4 companies in the country actually doing pure mathematics research, that's great. Also enabled the cost for data license and cloud computing services to be included in a claim. And that's really something it's been a really outdated part of the scheme for a long time. The fact that you couldn't claim for cloud computing services, for example, everyone uses cloud computing now. So that was just bringing it back into what companies are actually doing. And the other big thing that came in for claim period starting on after 1st April was the pre-notification requirement. So this is the requirement to tell HMRC that your client intends to make a claim for R&D tax relief, that needs to be done within 6 months of the end of the claim period. So really, we're only just now starting to see those notifications being required. There's some nuance in that around that's only required if a company hasn't claimed in the 3 years before the end of that 6 months after the end of the claim period, because they couldn't make it straightforward dates. So there's some ways to not have to do that, but there's, again, some complications around it. Then the big fun surprise of 2023 was the additional information form. So this had been announced and was expected to be enforced for claim periods starting on after 1st of April 2023. However, what HMRC and the government decided to do was bring that in for all claims submitted after 8th August 2023. So that was going to be the first, it got moved to the 8th. And this is for the first time HMRC actually mandating supporting information for R&D claims. So there's a mandated minimum number of project descriptions. So it's obviously if there's only one project, it's 1, but it's basically 3 to 10 for most projects, depending on the amount of cost represented by each project. It requires detailed cross breakdowns, and it has to be submitted before the CT 600. So that's actually tripped quite a lot of people up in the last 6 months or so. There's also been some issues with, obviously, HMRC systems not quite bedding in properly. So we've heard from quite a lot of clients that HMRC didn't see it coming in before the CT 600. There's been quite a learning curve on this. So in August, 50% of claims were not supported. There was not enough awareness within the R&D tax relief sector that AIF was required. I think that's down to now must be between 10 and 15% don't have an AIF based on the numbers they announced before Christmas. So that's where we had got to up until this April. So just to give a bit more detail on the R&D intensive SME scheme, because that came in new and actually only just be claimed for because it was included in Finance Bill 2023 and that didn't receive royal assent until last month. So again, this applies to expenditure incurred after 1st April 2023, and this was a way to compensate very, very technical, very R&D intensive companies for the reduction in rates for the SME scheme. So this is for loss-making SMEs whose R&D spend is at least 40% of the total trading and operating expenses for the claim period. The difference that makes is that they can get the payable tax credit of 14.5% rather than the 10%. So it gives an overall benefit of 27% of the eligible expenditure, which is still lower because obviously the enhancement rate is lower, but it's still much better than what they could have been getting. Now, as I say, this is only just come into force. So anyone that had claimed for expenditure incurred after 1st April 2023 can go back and amend that claim and claim as an R&D intensive SME. So we haven't seen many of these claims going through yet. We're not sure quite how HMRC are managing or how well it's working. On top of that, for claim periods starting on or after the 1st of April 2024, that expenditure limit is going to be reduced to 30%. So rather than the 40%, which is quite a stretch for most companies, is now 30%. And as we go into the merge scheme, those rules about grant funding and subsidies and also subcontracting expenses will apply through this scheme as well. So other few complications just to throw in, put in the slides, because it's been in my head the last couple of days. The key thing of this, and what is making a lot of complication in the AIF, because this has now been added to the AIF, is this, you have to take into account connected companies when you're doing this. So if at any point in the claim period, the claimant company had a connected company, and the way that HMRC is defining connected companies in the AIF would include group companies, you've got to include their total expenditure in R&D and their overall expenditure overall, and it has to be over 30% for all of those companies. So that means that when you're filling out the AIF, there actually is a requirement for a huge amount of information about the expenditure and R&D expenditure of all companies within that are connected to the claimant company. And I think that's going to make it really difficult for any company who's connected to companies to actually be able to claim this, or more importantly, to be able to provide the information to even show that they are an R&D intensive SME. So it's going to be interesting to see this as it beds in and see whether HMRC soften at all on, for example, the connected company rules. We'll just have to see. So that's the R&D intensive SME scheme. So the other new big thing that Richard talked about was the merged R&D scheme. So this is going to apply for claim periods starting on or after 1st April 2023. And the key thing about this is it merges both the RDIC and the SME. So all companies are claiming under the same scheme unless they're an R&D intensive SME. But in terms of the rules about expenditure, subcontracting, the types of companies that can claim, everything, it becomes all the same. All the rules are the same. The only difference with the R&D intensive SME is around how the money is actually, how the benefit is realised. So what this does is give an expenditure credit of 20% in the same way as the current RDIC, and that is taxable. It's using the current SME PAYE NIC cap rules, so that makes it easier for large companies. They won't be subject to the cap as much. And it allows subcontractor costs for all claimants. So this is a huge thing for large companies who haven't up to this point been allowed to claim for any subcontractor costs. So it's putting a lot more costs into large companies. It takes away the ability of SMEs who work as subcontractors for large companies to claim, regardless of the contractual arrangement. So it's going to shuffle the benefit around a wee bit. I think it will benefit large companies more than SMEs, but we'll just have to see. It does incorporate the ban on overseas R&D costs. So Kevin's going to go into that in a lot more detail. But this was something that was supposed to come in last April and was delayed to this April. So that is now coming in under the merge scheme. So in terms of overseas R&D costs, that is subcontractors. So any subcontractors overseas, and there's very complicated things that Kevin will go into. It also covers EPWs. So they're only going to qualify if they're subject to UK POIE. The big benefit and the big kind of simplification of the merge scheme is that grants and subsidies will no longer reduce the amount of tax benefit paid. So it doesn't matter if a claimant company has received payments from either a grant or potentially another company to do the R&D. Obviously, there's rules around subcontracting, but it won't affect it. It's not going to say you no longer have to say, right, these 3 projects are grant funded, so they're RDIC and these are SME. Everything goes in. For loss-making companies, so as I say, it's a taxable credit. So the tax benefit will be affected by the tax rate paid by the company for their corporation tax. But for loss-making companies, they'll pay the lower marginal rate of tax. So it will be between the 19 and 25%, depending on that, which means the overall tax benefit is now 15% for profitable companies, 16.2% for loss-making companies, and somewhere in between if you're paying the marginal rate in between that. So on the face of it, it's a simplification. As I say, Kevin will go into some of the more complicated areas around it, especially around the subcontracting. But overall, it at least brings everyone to the same set of rules for however they're claiming. But what this does mean over the next few years is we do have a lot of different schemes running simultaneously. So, and each of those has a different tax benefit and needs to be claimed slightly differently. So it's going to be a fun few years watching all of this wash through and helping our clients make sure that they are absolutely claiming the right thing at the right time through the right scheme. But just to give you a flavour of kind of the effect of all of this. So for expenditure incurred pre-1st April 2023, you've got the SME and RDIC scheme. So they've got their standard rates. So for a loss-making company claiming under the old SME scheme, they could get 33%, and a break-even company gets 18%, and everyone else gets something in between. And then the RDIC scheme is a standard 10.5% for everybody. We're then getting into expenditure incurred post 1st April 23. You're into the lower rates. So that's massively reduced the rates that SMEs can get. So it's between 18.6 and 8.6% benefit. And the RDIC scheme is now at 15%. So you can see they've come more in line, and actually there can be companies claiming that RDIC doing better than an SME. It's break even. Alongside those, obviously, we do have the R&D intensive scheme. So pre-1st April 23 there isn't an R&D intensive scheme, so they get the same rate as anyone else. But post 1st April 23, there's higher rates for them. So their rate is between 26 and 12.47%. And that actually stays the same once we get post 1st April 2024. And then, of course, for any accounting period starting too many dates. Accounting period starting post 1st April 24, we then only got the R&D intensive scheme and the merge scheme, and most companies will claim to the merge scheme. Just a wee thing to notice about this is there will be times when it's actually of benefit to a company to claim through the merge scheme rather than the R&D intensive scheme, even if they qualify for it. So a company that's break even, you get 12.5% tax benefit, whereas they'd get 16.2% benefit if they claim to the merge scheme. So there's the complications even of knowing, okay, the company is meets the criteria of an R&D intensive, but actually which scheme is the most beneficial to them. So there's a huge amount of making sure you know what scheme, what date, what company, and whether they're actually eligible for their R&D intensive scheme is going to come in over the next little while. Obviously, but this will all wash through, and at some point we'll be left with just the intensive scheme and the merge scheme, but it's going to be messy for a couple of years. I am now going to pass to Kevin to talk through the more complicated parts of all this.
This is where I get absolutely lost. Hi everyone, I'm Kevin. I head up the claim support and helpline function of the R&D community, and really what I'm going to talk to you today is where the merge scheme and the R&D intensive schemes differ from the existing rules. Just highlighting really a couple of key points that really you should be aware of, certainly if you're intending to put in claims for accounting periods starting on or after the 1st of April 24. I'm then going to move on to cover some recent guidance published by HMRC called the Guidance for Compliance 3. Which was published, I think, around about the end of October last year. So it's not legislation, but basically it is a little bit of clarification on the CURD guidelines on how claimant companies should be approaching their R&D claims, and it also stipulates the role of the taxpayer and the role of the professional advisor. And then finally, I'm going to talk a little bit about the GFC3 guidelines and what we're seeing in terms of compliance check activities from HMRC at the moment. So firstly, the overseas expenditure restrictions that are coming in. So first of all, there are absolutely no restrictions on any R&D costs incurred overseas through the current SME and RDEC schemes. So it doesn't matter whether you're employing EPWs abroad or in the UK, or whether you're having subcontractors work overseas on an R&D project or in the UK. It doesn't matter, providing they are contributing to the R&D activity and attempting to directly resolve uncertainties within that project or provide a supporting function that is essential for that R&D project, you can include them. So no new news there. The differences coming into play for accounting periods starting on or after the 1st of April 24, though, is really looking at those payments and limiting them. So for an EPW payment to qualify, the EPW earnings must be subject to PAYE and Class 1 NIC. So what that essentially means is that the staff provider doesn't need to be based in the UK, but they do need to operate PAYE and Class 1 NIC for that worker. It doesn't mean that that worker has to, all of their earnings have to be subject to PAYE and Class 1 NIC, but Class 1 NIC and PAYE needs to be applied to that worker at some point in their earnings for those total earnings to qualify for R&D tax relief. So this is quite an important point to consider. You may have a worker that is only in the UK for part of the year, but then it goes overseas and that part of the earnings is not subject to the PAYE, but the total earnings on that individual will be allowable under the scheme if that EPW is working part of an R&D project. So that's an important point to consider and a difference compared to the existing rules. One other complication is that there is a restriction on payments made to subcontractors. So if a subcontractor is working on an R&D project, those activities need to be undertaken in the UK. So it doesn't matter here whether that subcontractor is based overseas, but those activities need to be done in the UK for that payment to qualify. So this raises a few issues because it requires a company that is paying or contracting our R&D activities to another entity to be fully aware of where those activities are going to be undertaken in order for a payment to qualify. So that requires the contractor to be completely transparent with what activities are being done and where they're being done. Because it may well be that a company engages with a UK contractor to do work, but that contractor is part of a wider multinational group, and those activities are then undertaken overseas, in which case the payment wouldn't qualify through the R&D tax relief scheme. So what this is really highlighting is that these discussions need to be had, and the position needs to be evaluated before including a payment to a subcontractor in an R&D claim, whereas beforehand this could be overlooked. If the subcontractor condition is only partially met, then a view needs to be taken of those activities that were done in the UK and those activities that were undertaken overseas. So again, we need full disclosure information from the subcontractor of where those activities are being undertaken. And in practice, we'll see how this transpires, because it may well be that a contracted party undergoes numerous activities that form part of the R&D project, and some of them could be overseas and within the UK. And how a company can reasonably assess, form an assessment of those activities, and the evidence that can be provided to support a payment is something that we're going to have to see how HMRC respond to. I just should say here, the overseas expenditure restrictions that I'm covering here, it's draft guidance at the moment from HMRC. There was an open consultation which closed on the beginning of March. HMRC are currently looking at those responses, and they're going to finalise the guidance, I think, in the next month or so. So we will see how whether that guidance changed based on the feedback that we've provided, certainly within the R&D community. One final point here is that the overseas expenditure restrictions on EPWs and subcontracting payments don't apply where conditions are necessary for the R&D are not present in the UK. So a few examples here would be a clinical study that is required, and the clinical trial participants are all based overseas. Therefore, the work has to be undertaken overseas. It could be that maybe a drug needs approval under certain legislation, so therefore the work has to be undertaken overseas. In those situations where it is regarded that it would be wholly unreasonable for any of those activities to be undertaken in the UK, then the exemption will apply. So it does mean that companies will need to start planning their R&D activities, and where some activities can be performed in the UK reasonably, they should be looking at trying to get those activities performed in the UK. In cases where those activities can be undertaken overseas and in the UK, then the payment that would be qualifying for R&D tax relief would be restricted. It would basically, if all of that work is contracted out to an overseas entity, but say 20% of that work could be undertaken in the UK, then only 80% of the payment to the overseas company would qualify for R&D tax relief. So it's complicated, and I'm sure it is going to cause or generate a few discussions between taxpayers and HMRC concerning what evidence is required to support the inclusion of some of these payments. Next slide, please, Jen.
Sorry, Kevin, just on that point, we should probably stress that some of this is based on HMRC's draft guidance, and there might be some change when they kind of confirm it, because we've, as you said, kind of gone back to them with some kind of points in the feedback in the consultation saying, look, this would be simpler if you did it a different way. So we are expecting a little bit of kind of flux and change in the rules and the subsequent guidance that comes out.
Another big change really is subcontracted R&D expenditure, or what HMRC would now term as contracted out R&D. So the existing SME scheme, HMRC have taken the view, certainly over the last 2 years, that if you are undertaking R&D activities that stem from a contract, then that contract may not be specifically for R&D, but if you are performing activities under a contract and R&D is required, then you cannot claim under the SME scheme. So it's led to the situation whereby many companies are basically engaging a contract for goods or services with a customer, and in order to provide those services, they have to do their own in-house R&D to fulfill that contract. And under the existing rules, HMRC have kicked back on that and said you can't claim for that because you're acting as a subcontractor. The problem with that approach is that the customer, the person that is requesting those goods or services, may not have an idea that R&D is required or has been undertaken, and certainly wouldn't likely have the necessary evidence to support a claim for R&D tax relief. So in those circumstances, the subcontractor can't claim, but also the customer can't claim. This is slightly different from payments for an unconnected subcontractor that qualifies for R&D, whereby a customer needs someone to do R&D activities as part of a wider R&D project. And in these cases, if that subcontractor is unconnected, you can obviously claim 65% of the payment. If that subcontractor is connected, then you look at the relevant expenditure of that connected subcontractor. Under the RDEC scheme, obviously, you can only include payments to subcontractors under certain conditions, and that's if you're making a payment to a qualifying body, an individual, or a partnership of individuals. So the key difference really in the merging and intensive R&D intensive scheme is generally HMRC is saying the customer can claim if they can prove that R&D has been intended or contemplated at any point before or up to the point of drafting up the contract, agreeing the contract with the contractor. However, the subcontractor can claim if R&D is initiated at their own choice, really. So if they receive a contract to provide goods or services, and they discover that they perhaps need to do R&D to fulfill that, there's maybe an advance in mechanical engineering that they're looking at. If they make the choice to do R&D to fulfill that contract, then they can claim. What this means is that there's much more emphasis now on the contract and the talks that go on before that contract is signed, because for the customer to claim, they need to know that R&D is required. The intended or contemplated requirement is crucial here, because what HMRC are expecting is that it's not sufficient for the customer just to say, I want a piece of bespoke machinery developed for me. They've actually got to be able to articulate, I want this device, it's going to require an advance in mechanical engineering, and it needs to resolve uncertainty concerning this. So the customer has to have a clear idea that the work that is being contracted out will require R&D for tax purposes. If they're not able to provide that evidence, then it's very likely that HMRC are going to say, well, actually, as a customer, you can't claim for this because you didn't intend or contemplate R&D for tax purposes before the contract was drawn up. This will allow the subcontractor to actually make a claim. And this probably feels a little bit more natural, because it's more likely that the subcontractor is going to have the competent professional and the evidence in place of work requiring the resolution of scientific or technological uncertainty. One important thing to note here is that, as before, the customer can still claim for routine subcontractor work that is required as part of a larger R&D project. So a customer requiring testing service, they build a prototype and they want it tested elsewhere. As part of its wider R&D project, it can still include that as a payment to an unconnected subcontractor. However, it does raise a few interesting questions as to, well, in those instances, the customer's claiming because that test is required as part of a wider R&D project, but it may well be that the subcontractor doing the test actually needs to do R&D to build a better test criteria. And in those cases, it's not yet apparently clear how it's going to pan out in terms of how HMRC is going to view that evidence, because obviously the customer can claim, but the subcontractor can claim because essentially it's doing a routine task, but it has also chosen to do R&D of its own accord. And then finally, one last point here is that obviously this is complicated even further because the overseas restrictions apply, as I mentioned earlier. So this is something that they're really the two key points of the new schemes that need to be considered. Jane, can you move me on to the next one, please? I'm then now going to move on to the guidance for compliance 3, which I alluded to at the start of my chat. This is really useful because it provides additional clarity on the CURD guidelines. Some of this GFC guidance is lifted directly from the CURD guidelines, but it provides additional flavour through a number of worked examples where the definition of a technological uncertainty is met, for example, or an advance in science is met by a taxpayer. And I think this is really helpful because we've had the CURD guidelines have a few worked examples, but they've not been updated in about 15 years. And just getting a new flavour of how HMRC views qualifying work and the boundaries and scope of R&D is really useful, not only when compiling a claim on behalf of a taxpayer and providing advice, but also in situations where HMRC is challenging a situation. You've got additional examples that you can present to the compliance team that you could align activity with. So it's very, very helpful in those situations. GFC really covers all the main criteria for eligibility. So as I said, it describes what HMRC would be expecting in terms of an industry baseline, what the definition of a technological or scientific uncertainty is, what not readily deducible means, and importantly, it also emphasises the importance of a competent professional. And it's the competent professional that should be making the assessment that the work qualifies for R&D tax relief. And this is the key thing, because I think in the past, companies need a lot of help and support from professional tax advisors in certain circumstances because the guidelines are complex. But in terms of evaluating the evidence that is presented, it's the competent professional that really has the knowledge to be able to form a view on industry baseline capability and publicly available knowledge. And it's the competent professional that can make the assessment that, well, actually, we're going beyond this, but there's real uncertainty in what we're trying to achieve here. So it's really important that the competent professional is the right competent professional when you're making a claim and presenting a claim to HMRC. And the guidelines actually give a few examples on how the competent professional should be viewing R&D activities and planning R&D activities. So what GFC3 is really looking at is it's requesting companies to be a little bit more methodical in how they pull together R&D claims and how they consider that R&D is required and to what extent it's required, so that the boundaries of R&D for tax purposes are well defined, as opposed to we're actually just developing this project and therefore everything relating to this development work is R&D for tax purposes. So it's a really useful document, I feel, that both taxpayers and professional advisors can use in helping them get the right evidence to present to HMRC to support a claim. Okay, and I think that's probably that slide. Yeah, just going on to the next one, Jen. And yeah, so finally, how we see the compliance side of HMRC operating at the moment is that it is very binary. There is an awful lot of claims being rejected on the basis that HMRC doesn't see any evidence of qualifying activity. And this is something that certainly has become a little bit more prevalent in the last couple of years, whereas 5 years ago, 10 years ago, it was more about providing sufficient evidence to HMRC so that an understanding could be arrived at that R&D for tax purposes occurred, and maybe not in all cases, but usually it would be a situation where a compromise was met with HMRC because sufficient evidence would be provided to support certain aspects of a claim, but maybe not others. What we're seeing certainly over the last couple of years is that the compliance check activity has been a lot more binary. It's either been an acceptance or a flat-out rejection of R&D claim and a request for further evidence. But that's even in cases whereby, you know, there are several projects presented. It's more typical now to see HMRC saying, well, actually, none of the claim is not supported. We're rejecting the claim in full. The compliance, the GFC3 guidance is a lot softer than the approach seen from the compliance team at HMRC. So the examples given seem a lot more fair and reasonable compared to some of the arguments that are being presented in a compliance check situation. So it's going to be really interesting to see whether that GFC guidance is accepted by the compliance check team going forward. I think it's a useful tool in certainly defending claims and being able to show how a claim potentially aligns with the CIRD, especially in certain circumstances where HMRC are perhaps raising the argument that the project is too commercial. It doesn't relate to an overall advance in science and technology, for example. So I think it's going to be really useful to see how those examples are taken on board by the compliance check team within HMRC. So why is GFC3 important? It's important because it's based on the CURD or the DSIT guidelines. But it provides structure. It provides a structured framework in which evidence can be presented to support a claim. And I think this is really quite useful because that's something that the guidance has been lacking in the past. What it clearly shows, I think, is that there is certainly the requirement for planning of R&D activities by the taxpayer and the recording of activities by the taxpayer, and also accepting the responsibility of the claim. Certainly compliance as it is being managed at the moment, it's not unusual to see penalties being applied to claims with the view that maybe the taxpayer has been careless in bringing together the information. and those penalties can be quite severe. I mean, typically a careless penalty would be up to 30% of the potential lost revenue. So HMRC is certainly wanting the taxpayer to accept responsibility of the claim. It is the taxpayer's responsibility to ensure that anything going in on the tax return is correct. But the role of the professional advisor really is to provide help and support whereby a potential R&D project has been identified by the competent professional, but there's perhaps a little bit of effort required in terms of mapping qualifying activities to the legislation and also excluding those activities that would not be seen by HMRC as being qualifying. And it's also about assessing and communicating the risk of an R&D claim. And this may be because of the lack of sufficient evidence to support a particular aspect, or the inclusion, for example, of a payment to a subcontractor, and some of those roles are undertaken overseas. That's really the role of the professional advisor, I feel, in going forward. Okay, I think that's me, Jen.
Brilliant. Thanks, Kevin. Just quickly on both Richard and I gave you a really quick overview of our joint offerings earlier on. So just to give you an idea of an offer that we're running today, if anyone in the audience is interested in engaging with us after today. From a WhisperClaims perspective, we can give you access to a 30-day subscription-free period of our software, which includes a free report download in that same period, along with a free claim review as well, where Jen will take a look over your claim before you submit it to HMRC to give you some direct feedback. And of course, open access to the advice line that I described earlier on. Total value of that is about £950, so it's a significant offer. I'm going to post up a poll in a little minute to give you all the opportunity to engage with us around that anyway. But over to you, Rich, just for your offer as well.
Cool, thanks, Mike. And yeah, we don't often do this. This is only because we're kind of teaming up today with WhisperClaims. But for people that sign up off the back of the poll that Mike will post shortly, we're also giving a 3 months membership. So that will be at a minimum £150 for a single user. It could be £600 if you've got a team of 10 people. We've got kind of per head pricing that you can check out on our website. That will allow you to access the helpline. So to ask Kevin these kind of detailed questions about the scheme or a particular client. It will also potentially give you access to our claim support services, and you'll also get kind of invited into our community group, so you can kind of experience what it's like to be actually in the community for that month to see if you like it. Quite apart from that, again, I would kind of point you at the free course that we've got on our website on the merge scheme, because that covers a lot of the stuff that Kevin and Jen have been talking through in terms of the restrictions on overseas expenditure, the new subcontracting rules, what the deal was with subcontracting in the old scheme. A lot of that stuff is all there and it's for free. So I'd kind of encourage you to dig into that if nothing else at all.
Brilliant. Thanks, Richard. So the poll's just gone live there. I'm going to leave that up while we go through the Q&A. So that'll be there for the rest of the session if anyone wants to jump in. So on to, if you can just pop the next slide up, Jen. Just on to Q&A. And Joe, are you happy if I run through the questions? I think that means yes. Brilliant.
There's been lots going on in the chat. Lots going on in the chat, Mike, which is great. I can see there's lots of stuff gone in there. There are quite a lot of questions. I think we've got about 10 open questions. So I'll leave you to decide how many we can actually answer live. But I thought it would be better if you direct them to the right expert. So I'm going to put those into your hands. Yeah.
No problem. Okay, I'll just quickly run through. So we've got one. Oh, hold on a second, because they're still flying in actually. Well, first one from Richard Ellis. Sorry, idiot question, not an idiot question, Richard. How do we get access to the R&D community? Hopefully you've already responded to the poll there, so that's fantastic. Right, we've got one from Lee McManus. Maybe more semantic than a technical question, but how many defined schemes will there be now for claims after 1st of April 2024? Merged RDEC plus SME intensive scheme, or is the intensive scheme just being considered a specific case of scheme one? So it's all about the overlap between the schemes. Richard, do you want to take that on?
Yeah, sure thing. So again, we go into this in the course because we're in this kind of weird situation where we've actually got 4 concurrent schemes, which will potentially last until end of February 2027. So we've got the new merge scheme for accounting period starting on our 1st of April 24, and the R&D intensive scheme for small companies that are loss-making. But then, of course, we've got the legacy SME and RDEC schemes as well, and those won't wash out until about 2027. So yeah, there's just a huge amount of kind of complexity in this crossover period, unfortunately.
So just on the semantics of it, if you look at the legislation, they're treated as 2 separate schemes. So there is a chapter in the legislation about the merge scheme, and there's a chapter about the SME intensive scheme. So they are seen as separate schemes. And yet there's then like a 3rd section in the legislation that covers the actual rules, and those apply to both. So technically, from a legislative point of view, they are 2 separate schemes, but actually in terms of all the rules and everything like that, it's a different way of claiming the same expenditure.
Yeah, and if I have kind of look into my crystal ball and think about what is likely to happen in the future, I think probably what will happen is that they will simplify things further, and they'll say, okay, in the merge scheme, if you're a loss-making SME, you'll be able to claim at an enhanced rate, and they'll kind of change the rate within the merge scheme if you fit certain criteria, rather than having a whole separate scheme, because what we have right now is a bit of a knee-jerk reaction, I think, from the government's side of things.
Great, thanks, Richard. This next one's a little bit down in the detail, but it's a sort of question that gets asked quite often. So this is from Ryan. If a company is filing an amended R&D claim to get the additional R&D intensive rate now that it's available to claim, does a second AIF form need to be filed, or can they just file an amended CT600? The company would have already filed an AIF and a CT600 to claim the 10% credit. Anyone got a view on that?
I would recommend that you actually resubmit the AIF. You don't want to give HMRC any reason for questions. I don't think there's a legal requirement, but the AIF now allows you to basically include evidence as to, say, for example, meet the criteria of the R&D intensive threshold. So I think, you know, providing that evidence through the AIF will prevent that question being asked in a compliance check.
I think someone else has asked a similar point, and I would say definitely doing an AIF. I think looking at the way the question is structured in the AIF, it's, do you want to provide evidence that you qualify? And the answer is yes, I'm going to do that now, or no, I'm only going to claim 10%. So much as it's unclear as to how mandated this is, you're asked to state very clearly when you do an AIF that you are or are not going to go for the 14.5% rate. So the way that it is structured and worded within the AIF, I would say is definitely something you should do.
Cool, thanks, Jen. I've noticed a lot of people are asking if the slides have been made available afterwards. We'll be sending a follow-up email out in the next 24, 48 hours, and there'll be a full recording of the session, so you'll get to see everything again if you need to. Just skipping through, there's a good one here from Lee. Any decent and clear guidance on how to determine and communicate the risk of claims? Is this risk based on claims in specific industries, size of claim, and prior experience? Jen, do you want to take that on?
I can, but I think Kevin does more inquiries than me. It's really difficult. If you'd asked me this question 2 years ago, I'd have been, yep, here's a full list of all the things that we know would trigger an inquiry and make a claim more risky. These days, it's really difficult to say. As I'll let Kevin comment on themes that he has seen, but at the moment, HMRC are doing things like picking a particular sector and inquiring into a certain number of claims within that particular sector, for example. So it's difficult to, the only risk there is that having submitted a claim makes it risky, and that's all we can say. But I don't know, Kevin, if you've got a more detailed viewpoint.
I would say yes to all those points. The size of the claim isn't necessarily a trigger for a compliance check now. We're certainly seeing lower value claims being inquired upon by HMRC. Specific sectors, well, apart from the danger sectors where you wouldn't normally expect to find R&D, such as say, for example, care homes and such like. There's certainly a focus on software, and the simple reason there is that quite often software development has been seen as company developing a new piece of software, a bespoke piece of software that has some kind of functionality, would normally consider that to be R&D, whereas actually, you know, R&D for tax purposes may only apply to a certain part of that development work, or it may well be that that bespoke software solution can be created just using routine methods and tools already available in the realms of computer science. So HMRC are certainly focusing on software claims, making sure that the boundaries of R&D for tax purposes has been properly defined. Yeah, I mean, I would just say that, you know, the risk is there, and as it's always been, but the rules that we thought that were being applied are perhaps not being applied in all cases. So lower value claims are being challenged, and software claims that were considered to be typically strong are being certainly challenged by HMRC.
I think there's sorry if I could just come in on this as well. There's a really interesting point around the risk is now no longer just within the claim information that you're presenting to HMRC. It's actually how you are presenting your services to the outside world and how you're trying to win new business as well. Because we know that in certain situations, HMRC during an inquiry is looking at the website of the provider and the agent and saying, well, actually, we're not happy with how you're kind of presenting this. So they're taking a kind of wider picture now and a more kind of holistic view of risks in the market. And I would suspect that they, behind the scenes, have got a list of, you know, good providers that they're happy with, advisors that they're definitely not happy with, and you absolutely don't want to be on that unhappy blacklist. And that's why we actually built a course on marketing, like some of the do's and don'ts in terms of the messages that you're using out there, because you can hopefully reduce the risk level within your service just by being conscious of some kind of words and phrases that HMRC really doesn't like. So yeah, we're going through some quite unprecedented times, I think, at the moment.
Yeah, brilliant. Thanks, Richard. I'm conscious we're a minute over time. There's one last question that I do want to ask, because it is a great question. So we'll treat this as the last one. This is from Adam. Do all group companies claiming R&D need to be intensive to qualify for this rate? Jen, I know how much work you've been putting into that area in assessing how we manage the app. Are you okay to take that one up?
Yeah, I was just trying to work out how to answer this question. So on an individual basis, no. So mathematically speaking, so the way it works is that just going with the way the AIF works, you put in the trading and operating expenses for all of the connected companies, all the companies in the group, however you have to cut it. And then you put in the R&D spend for all of those companies as well. And then essentially the whole group of them, it's one number that comes out, so that all of the connected companies hit that 30, you know, all of that summing of everything comes to over 30%. So what that means is you could have some connected companies in there that do a tiny amount of R&D. They could have like 5% of their trading and operating expenses is R&D, and then another company in the group where 90% of their trading and operating expenses is R&D. And then because it kind of averages out over all the companies, that company that's spending less on R&D could still technically, looking at the way this works, I'm not saying this is definitely how HMRC would cut it, could claim as an R&D intensive SME because you're looking at the group companies, not the individual company. So again, it's only just come out and we don't know exactly how HMRC are going to apply this, but based on the questions they ask and the way they assess it, you could be a company that isn't R&D intensive on its own, but if your connected companies are very R&D intensive, then that could pull you up into that status. On the other hand, you could have it the other way, where you've got one company within a group of connected companies doing masses of R&D, but none of the others are doing anything, and that would pull them below the R&D intensity threshold. So it will work both ways, where you could have it that one company doing lots of R&D actually pulls everyone else into being intensive, or all the other companies doing nothing and one doing not as much. That company wouldn't be allowed to be intensive. So it's an interesting place to be. And the one thing I will say about this is group companies and connected companies, the way that HMRC are defining it, they're calling them connected, but it says that it's any companies with common ownership, which would cover groups. I forgot what my point was going to be there. The point is that you have to have access to all of this information to be able to claim as an R&D intensive SME. So if you go through the AIF, it will ask you for the trading expenses and the R&D expenses of all connected companies at any point in the claim period. So if you can't provide that information, the advice is don't claim. You know, if you say, no, I can't provide this information, you're then put into, I will only use the 10% rate. So even if you know for sure that you would hit that intensive rate, if you can't provide that exact information, then you can't claim as an R&D intensive SME anyway.
Yeah, just to be clear, Jim, when you say don't claim, you mean don't claim under that scheme?
Yes, you'd have to just claim under the merge scheme rather than as an R&D intensive SME.
Yeah, perfect. Brilliant. Well, we're well over time, so I think we should stop there. Apologies to anyone who's asked a question we haven't had time to answer. As I said, we will be sending out a follow-up email in the next day or so. And thanks everybody for engaging with the poll and engaging with the session as well. Joe, anything from you before we go?
No, just to reiterate, we'll send on the recording, and yeah, look forward to our next webinar. Thank you to all our speakers today, much appreciated.
Brilliant. Thanks everyone. See you soon.
Thank you.
Thank you.
Bye.
Thank you.